All right, hey, welcome to Furstenau Financial. I'm Ryan Furstenau. We have Tyler Lindsay with us today.
Yeah, it's been a while.
Yeah,
It's been a while.
Thanks for joining us. So, yeah, I mean, usually we've been doing a lot of individual videos, but we got both of us here today because we wanted to talk halftime update. And we actually just finished up our in-person halftime event a few nights ago. We had quite a few clients come in, and we just spent some time talking about kind of what's been going on for the last 6 months or so, and kind of some of the outlook that we have coming up for the next 6 months or so. And so we wanted to pass along some of the key information that we had from that night. So. But Tyler, I kind of wanted to start just give some numbers on where we've been over the last 12 months.
Historically, that'd be good.
So just to share what's been going on, a few key numbers. The S&P 500 index over the last 12 months is up just a little bit over 20%, of which about 10% of that is year to date. The Dow Jones Industrial Average is up a little over 18% in the last 12 months. The NASDAQ is up a little over 26% in that time frame. Maybe the key difference between a couple of those, the S&P and the Dow, big companies, large companies, the NASDAQ generally smaller companies. So a little bit difference there. So you can see some of the smaller businesses have done a little bit better in that time frame. Gold is up about 21%. Oil, unfortunately, is up almost 20% in that time frame as well. It was higher earlier this year. And then the MSCI EAFE index, which is foreign companies, also up just a little bit over 20%. So the last 12 months, it's been really good, hasn't it?
Yeah, definitely. The last half of 2025, it seemed like we had a lot of growth. And then we had hit I know you're going to talk about it, but we're going to talk about the war that happened as well. Kind of stifled it a little bit. But 10% on the year, that's pretty amazing with the way we started in that mid-spring war conflict, I should call it.
Yeah, so we definitely have had bumps along the way. And so with the Iran war, we had a pretty good dip earlier this year, but that's all been recovered and then some. And actually projections for the U.S. Companies are continued growth through the end of the year. And so probably want to talk a little bit about that. And so companies have been going up, Tyler.
Mm-hmm.
How can they keep going up? Why would that happen?
Yeah, so earnings have been good, right? So we've been seeing robust earnings over the last, and we're projecting it to be good earnings as well. But that's been the driver of all these companies. And we look at the companies individually, the heavy hitters like the S&P 500, those giant companies, because you have large, but then there's these giant guys.
Yeah.
And there's about 7 companies that make up about 30% of the weight of the S&P 500. We've been saying that for a few years now, right?
Yeah.
Kind of the big push has been AI. A lot of spending going on in AI. 5 years ago, AI was there, but it wasn't as good. Now there's a lot of spending going on, and I know you have some numbers for that, but that's pushing the market, and some of the earnings are reflecting some of that change in these companies, getting more efficient.
So is AI? Give us the history on AI. What is it doing or not doing, or what's it going to do? What does that look like?
Yeah, that's hard to say though, right? What is it going to do? Well, if you think about 5 years ago, I mean, we had the video version of it, but it was all choppy. Like you could tell this artificial intelligence to do something, and it would do it, but there would be a lot of bugs in it, right? Okay. Over the last few years, it's been getting better. And I guess the progress from 2021, 2020-ish to now is like you can't really tell the difference between what's real and what's not. And that's just in the video space. And these companies aren't using it for videos like you see on Facebook or you see on some of the social media sites. They're using it for efficiency.
Okay.
And so as you can see just with that video, the videos that are being made, what's going on within small companies, large companies, is helping them have better earnings as well. Maybe they can do things a lot quicker and grow their business more efficiently.
Yeah, and that's what we've been, so most of the AI profits or where money is being made with relative to AI right now is the investment in AI technology. So companies are wanting to use AI, and they are investing by spending on companies that are developing AI. So those companies that are developing it are really benefiting because people want their what they do, right? They want their expertise. And so that's where a lot of the profits of companies have been coming in, is from that investment, but not necessarily the results of the AI.
Yeah,
so like
we
you
haven't
said,
seen it yet. We don't know where it's going yet.
yeah, we don't know how that's, we don't know how, is it going to drastically improve efficiencies? Is it going to slightly improve efficiencies? That's going to be like the next stage, you know? So like where we are right now and where we've been is investing in AI technologies. Where we are going is, how is the AI going to fulfill on the promises that, they think it can be? So that's something that people are like, oh yeah, it's all AI making everything go up. Well, it's investing AI. We really haven't seen the results of AI yet, but companies are using it. We use it in our business. We use AI technology when we have client meetings. We use AI to help us with our trading, and so we are investing in AI and learning how those can make us more efficient. And we've already seen things that have made it more efficient, but it's just going to continue to even get better. So that's one of the big things with companies, and then their profits, right? Yeah. So what's interesting is, so far this year, the companies, the profits have been up, right?
Yeah, and we have some more earnings coming out here in the next coming weeks too. So we're going to see some more to see what, the first 6 months of all this spending on the technology and this AI, what it's actually producing. We're not going to see it quite yet. It might be a year or two down the road. Yeah. But I'm sorry to interrupt.
No, go ahead.
When we were doing our halftime report, our American Funds representative mentioned that there was, I think it was 500 trillion was projected to be spent at the start of the year for 2026. 500 billion, okay. $1 billion, and we're already almost at $1 trillion in July.
That have been spent.
That has been spent on AI technology.
On AI technology.
And if you look at
it's an expense for companies that are investing in it, but it's a profit for companies that are the ones serving them.
Yeah. So that's kind of neat. And so 50% of the GDP growth is coming from 5% of the companies. And 5% of the
So we're getting, so a lot of our growth that we're getting right now is coming from a small number of companies, but they're big companies also, right?
Yep.
Yeah. So we started out the year with some high earnings, some high price to earnings ratios. Yeah. And so when we talk about that, so price to earnings, so it's basically what is the company trading at versus what does it earn, okay? And if the price is up here, let's say it's $100 per share, and the earnings were $20, it would have a ratio there, a price to earnings. If you had a company that was priced at $100 but it had $30 of earnings, that would be a better ratio because the earnings are higher relative to what the company's priced at. Okay, right. And so one of the things when we're investors, we want to see higher earnings because that means the value can go from $100 to $120. It can support a higher number because it's worth more. If the company makes more money, it must be worth more. Well, that price to earnings ratio at the beginning of the year was in the 30s, mid 30s, and now based on the things getting better and companies projecting higher profits, even though the prices have gone up, the earnings projected has also gone up, so that the price to earnings actually like forward projected on average is in the mid 20s. Yeah. So that gives us an outlook that says, hey, this is sustainable, that we can have more growth between now and the end of the year, or now and 12 months from now, because the earnings are projected to continue to go up. Which, to back up a little bit, we're actually in the third year of a bull market. From October 2022, it is actually S&P 500 has gone up 100% as of May, and June's have been a little bit higher. So it's up about 100%. So it's basically doubled in that time frame, in that 3.5 years. And so you might say, well, wow, we probably that's pretty good. We've probably gotten is this over? Right? Are things going to crash?
So that's when I meet with clients, it's like that's usually the first question. We've been so high, and they're like, I have this feeling that it's going to go down.
Right.
But the facts, like we were just talking about, all that's that the price to earnings ratio, the values there, it's not saying that. So the facts are saying a different story. So sometimes, even though as investors we have we think about like the 2008s, the 80s when interest rates went up. Those kind of gloomy times. When we're in good times, it's in the back of our mind, but we do have short-term memories because we also don't remember how it felt when the market went down 20%.
Right.
We feel some of it, but we keep that in the back of our mind.
And some of
good times.
And some of the AI boom is comparable to, or people are trying to compare it to the .com boom in the early 2000s. But the numbers are totally different. There weren't the earnings back then, but things were going through the roof, but the earnings weren't supporting it. So it's totally different than what it was. But being 3.5 years in, an average bull market's actually 5 years. So 5 years, we're in the middle of it still, or middle of a potential historically. We're right in that time frame. And actually, once a bull market has doubled, on average, I don't know if you knew this, on average, it could potentially go to like 260%.
Really?
So just because it's doubled doesn't mean it's like maxed out. It's like that kind of reinforces that there is more potential there coming. So,
wow.
So I think that's a really good outlook for the year. One of the things that the challenges that we've had this year is that we were kind of hoping inflation would be going down. The Fed had raised some interest rates to kind of try and curve that, and then they backed off a little bit on interest rates. But inflation actually is maintaining or maybe even growing a little bit. I say inflation, so do you have a good example of like what inflation actually is?
I do. So, and when we had Will talk about this in our meeting, so the people that are watching this and they're seeing this, they might see it for a second time. But 30 years ago, in 1996, what did a stamp cost? And I know you know the answer, but just take a wild guess.
I'm gonna say 32 cents.
32 cents. That's what it was.
Wow, that was a good
32
guess.
Cents. Now
it's like I knew the answer.
Yeah, I know. But now it just went up. It's 82 cents now.
So a stamp went from 32
30 years ago
to 82
today.
Okay, so it's grown by 2.5 times in that time frame. Okay,
so that's important because we're seeing that's just with stamps. That's you're seeing it with vehicles, you're seeing it with groceries. Some products more than others based on the demand, obviously. But for 30 years, that's pretty consistent with like about a 3% inflation rate.
Okay.
Even though we're going to have some of those years like we did a few years ago where it was 8 or 9% inflation, but we also had 10 years from 2010 to 2020 where it was less than 2%.
Right.
So we need to get back to that average, and 4% or 4.3%, a little over 4. I can't remember the exact number what they came out with, but it's not 8%, and our prices aren't going down, because if we have deflation, that's a worse problem.
That's a bad problem. Yeah.
It's bad.
So a little inflation is good or is normal. But we don't want a lot. But I guess the projections are we don't think it's not going to go down. It's going to kind of maintain. Yeah. And so probably what we're going to be seeing as far as investors, we look at the interest rates that we're getting on our investments for like our fixed investments, our money market, our short-term investments. Those rates are probably going to stay the same. Yeah. Potentially, if they have to raise rates, they would go up maybe a little bit. But we're kind of thinking the rates are going to be the same for longer rather than going down. Probably not. Maybe slightly shifting up a little bit.
Yeah, maybe a 0.25% change upward, or the labor market. We didn't talk about that. The labor market has been steady the last few months, so that reinforces the idea that people are working and they're spending, and so. The Federal Reserve was actually just talking about this, that the labor market looks okay. So maybe they don't increase, because they were projecting at least 2 rate increases.
2 rate increases, and now
maybe one, maybe
it's
not.
one.
Yeah, maybe keep it steady.
Yeah, which at the beginning of the year we were hoping for to lower
go
rates.
the other way. Yeah.
But the Fed right now they have been wanting to be very aggressive to get inflation down to like what 2%.
2% our goal. Yeah.
Which I guess I don't think that's a realistic
It's a
goal
lofty
because
goal.
the last 100 years we've averaged 3.
Yeah.
So to think that we could maintain it at 2 for an extended period doesn't seem quite right to me. But that's kind of the way they are thinking anyway. So rates probably the same, maybe slightly higher down the road. But if inflation maintains at 3 or maybe 4%, we can't just keep our money invested in money markets, right? Because you're treading water there. And that's why we want to continue to invest in long-term investments. We want to own companies because those returns are going to be potentially higher, historically higher. I just told you about the 20% return over the last year to stay ahead of that inflation number, because we need to have our money not only just tread water but also grow for us. So thinking about what should we be doing or what are we looking at? So things that are important are diversification, because we don't know what's going to be hot. Now if we look, those numbers I shared to start with, like everything was good, right? Yeah. But that's not always going to be the case, right? There are going to be, maybe Europe isn't going to perform as well as the US or vice versa. So going forward, we want to make sure that we are diversified. We're exposed to different areas. Yeah. It's not like, hey, I just want to put all my money in NVIDIA in one stock, because they're the AI, company. We want to make sure that we're spread out and we're diversified.
Yeah, having different exposure to different areas. And then, we saw it last year. Foreign was really good, right?
Yep.
U.S. the year before was better.
Was better than
so
foreign.
It flipped.
Yep.
So when we talk about that quite a bit with diversification, we don't know what's going to be good. We have an idea just from some of the numbers that we're seeing kind of the next 6 months. But we still want small companies. We want large companies. We want foreign. We want, if you're in retirement and you want some fixed income or need some fixed income bonds as well.
Yeah. So it's probably a good time to just, get with us and make sure you are, in balance, so it's always good to rebalance things, because if our stocks have done very well, and we have our money market and we wanted to maintain some sort of ratio of how much do we keep in money market and how much do we have in our long term. Well, if the stocks have gone up, well, that becomes a little disproportionate because it's grown more. So it might be an okay time to maybe take some profits off the top and rebalance to get, as we call them, our buckets, realigned. So that might be something that may be beneficial to look at. And once a year, maybe twice a year, things don't shift that much, but when you're rebalancing, that's all the more frequent that needs to happen. Oil, just a little backup. The oil, it did take a big spike with the Iran war, and then that has since come back down, not to the levels that it was at. And it's kind of maintaining, kind of jumping around here with some of the things that are going on right now still. So that's, oil is volatile, but it's not really driving our investment decisions, right? We have targets where we want to be as far as our ratio of how much U.S. to foreign, and we just want to maintain those ratios, independent, because we can't time the market, right? We don't know which is going to be the next one to be the best or the worst, but we do know over time, if we keep the ratios the way we want them, then we'll get some expected returns that we're looking forward to. But the other thing is we want to make sure we have perspective right now, because 20% is not a normal year over year expected return. Historically, the S&P 500 index or the Dow Jones or stocks in general have somewhere between 9 to 11% average annual return. And so that's, we're going to take 20% when we can get it, but we should know that that's above average. And at some point there will be something that upsets things and sets us back a little bit. But those are the times that we want to make sure that we're following our principles of patience and discipline. And we're going to have to be patient at times when markets don't do what we want to do, and disciplined and stick to our investment process. But expectations, if you're all stocks, maybe 9 to 11%. If you have some combination of stocks and bonds, some number that's a little bit lower than that. But when you have the bonds in there, you don't have as much volatility when we do have some of those disruptors out there. One thing that's is it going to be interesting. So a year ago, they passed the One Big Beautiful Bill Act, which had quite a few different tax changes that helped a lot of individuals have a lower tax situation from 2025. Especially seniors. There was an enhanced senior deduction. There were a handful of other things in there. And so what we are expecting to see is people maybe didn't pay as much tax as they might have without that. And if they didn't pay as much tax, that's going to give them extra money in their pocket, which people don't usually
spend.
Yeah, they don't usually save it. They
No.
usually spend it. And so it'll be interesting, for the next half of the year here to see how some of that spending plays out. And if they're spending more, companies benefit more. And, it could be another driver of the prices going up in addition to some of the AI investing that's going on out there. So maybe that's, I don't think there's any numbers, data that supports that, but that might be some of what is driving some of these projected higher earnings for these companies going forward is people are spending more, and some of that might be from some of those tax benefits. So, but so those are a few things from the other night. There are other things going on out there and more details and things that are specific to your situation that may not be specific to somebody else. So if you have questions about where you are right now, where you have been specifically, give us a call, stop in the office, send us an email. We'd be happy to answer any of those questions. And you might just have questions on what we talked about and not understand. We do this all the time, and so we might use some terms that kind of shoot over your head. But call us. We'd be happy to re-explain things or answer any questions you have. But otherwise, until next time, thanks, Tyler, for
Good to be back.
It's good to be back, and we'll do some more of these. So.
All right.